All right, chapter 12, exercise set. So we're learning about the balanced scorecard and other performance measures in this chapter, as it says. Anyone familiar with the balanced scorecard? No? Okay, so that is a tool that some companies use if they feel like just focusing on their financial performance is too limiting, and they'd like to look at other aspects of their business to evaluate their performance. They sometimes use the balanced scorecard approach. And we'll get more into detail on what it is. But I think it's a great idea because I think when companies focus too much on their finances, their profits, sometimes they lose sight of their impact on society or the environment and so forth. In fact, next week in chapter 13, we're going to get more into sustainability reporting. So it'll kind of be a continuation of this concept. And we'll look at other ways that organizations can measure their own performance as well as performance with divisions and individuals within the organizations. So the exercise set's not that long, 9 exercises, and then we've got, there are 6 problems in the problem set, and we're going to go through 4 of them together, if I remember correctly. So, like I said, it's going to be a pretty light week for you. I'm going to pause for a moment. Okay. In fact, you'll notice that a lot of these exercises are really more conceptual and not really mathematical. Did we talk at all about like decentralized versus centralized companies, or revenue centers versus profit centers? Does that come up at all? Not really. Okay.
I think the last part I remember
A little bit, not the centralized. Okay. So this first question asks whether these organizations are centralized or decentralized. So a company that makes most of their decisions centrally by a small group of people, usually the executives, we would call that a centralized organization. And then an organization that gives decision-making authority out at other locations or at lower levels of the organization would be decentralized. And really, most companies are somewhere in between, right? I don't think there are too many companies that are completely centralized or completely decentralized. But the challenge here in this first exercise, we're going to look at these 6 examples and try to figure out, do we think this type of organization is more likely to be centralized or decentralized? And the reason it's relevant for this chapter is because obviously, if you're going to measure the performance of your organization and it's centralized, really it's only the people at the center that have control over the decisions, right? And on the other hand, if you extend that decision-making out to the front line or to the lower levels of the organization, or other facilities, then you might want to hold those folks responsible for the decisions that they make, right? So it impacts how you measure performance. And the first one here is this furniture company. It says they're a small builder of side tables, and they're managed by a sole proprietor, so a single owner of the company. Do you think that company would more likely be centralized or decentralized?
Centralized.
I would agree, because that owner probably wants to maintain control of their small business. The second one, a marketing company, it says they want their advertising team leaders to be able to respond quickly to the needs of potential clients, so they have the authority to make decisions about advertising and pricing. Exactly. So that one is decentralized because they gave that decision-making authority to the team leaders. Then we've got Couture's Creations, has a single owner, manages basically everything. That's obviously centralized, right? Okay. Then we have the British Navy. I don't know why they picked British, but so military organizations do have a high degree of centralization. Has anyone here served in the military? No? Okay. Well, I think you could also argue that they do have some decentralization because the captain or command leader or whoever it is, I don't know all the different titles, sergeant, whoever's out on the front line, they have to make some decisions, right? They can't always call in and get approval from a general. So I think you could argue they do have some degree of decentralization, but the correct answer here, according to the textbook, is centralized. And same thing with F, United States Army, also centralized. Now, E is another one that I think is somewhat arguable. A McDonald's franchise. So if you know how franchising works, an individual can own the local franchise, but they don't really own the brand. They don't even own the property. All they really own is just the opportunity to be in charge and get some of the profits. So the correct answer here is decentralized, but McDonald's decides what's on the menu. They get to decide where you can put your store. They get to decide, I imagine they decide the price that you charge for your products, the marketing that you use. So even though the official answer is decentralized, like I said, you could probably argue either way on that one.
Would the military part be because the reporting back in of the hierarchy of it going from the lowest to the highest?
Yeah, right.
And then like instead of like McDonald's, that individual company probably doesn't report up to.
Yeah, I don't know exactly how much discretion they have and how much they have to report back up. I'm sure the parent company, McDonald's Corporation, I think it's called, I'm sure they know like what the revenue is, what the costs are. They probably keep close track on all that. So, but anyways, you get the idea, and those are the correct answers there, abbreviated for you. All right, any questions on this first exercise? All right. All right, so going on to number 2. For the following description, state whether the cost is controllable or uncontrollable by the responsibility center manager. So let's talk about this term, responsibility center. So oftentimes organizations hold managers responsible for the departments that they oversee, and that's pretty standard practice. But there are different types of departments. Some of them really focus more on bringing in sales. Others have nothing to do with sales. All they can really do is control costs. And then you have others that can do both, that can bring in sales and control costs. And then you have some organizations, this is not as common, but not only can they influence sales and costs, they can also invest the company's assets to try to expand. So these are the different types of responsibility centers. Okay, so on this question, we just have to decide if the costs are controllable or not. But when it says responsibility center managers, it's whoever's in charge of this particular facility. So the property tax of a manufacturing facility, would the manager of that facility have any control over property taxes? No. Okay, so I'll put a U for uncontrollable. How about research and development? Would the person in charge of that department have any control over the research and development costs for a product? Would. Yeah, okay. That is controllable. And the point here is, it wouldn't make sense to hold somebody accountable for something they can't control, right? So that's why it's important to understand what they can control and what they can't. I think, didn't we have some examples like the golf course example where there were 3 golf courses and then there were some allocated costs that they didn't really have any control over, and we saw that with some others as well. So it's the same idea here. Okay, how about the advertising costs for a product? Is that something that can be controlled? Yeah. Companies set a budget for advertising, and somebody makes that decision, and so yes, they would have control. How about insurance costs for the manufacturing facility? Yeah, uncontrollable. There are some things you can do sometimes to get your insurance costs down. Like if you think of your own auto insurance, you've got some discretion, right? Which features you want. Plus, by driving safely, for example, that helps keep your costs down. Same thing with business insurance. Sometimes there are some ways you can influence it, but in general, the cost is set by the insurance company and it's based on how much risk they perceive. Okay, the last one, the design of a product, can that be controlled? Can the cost for that be controlled? Yes, yes they can. Okay. Yeah, that's right. Okay. Okay, so only A and D were uncontrollable. See, isn't this easy?
Easy peasy.
Going on to number 3. Okay. Here's where we see the different types of centers. So over here, a revenue center would be a department that really just brings in money. That's their job. Every department's going to have some costs, but when you have a department that's like a sales department, telemarketing department, advertising department, their whole job is to drive sales, right? And so a lot of times you'll focus just on their revenues, not really care too much about the costs, not really worry to evaluate you'll still track their costs and look at them, but mostly they're going to be judged by how much revenue they're generating. And I will tell you too, you might have noticed this if you've worked in different companies, the departments that generate revenue tend to get treated the best. Especially if, like, let's say layoffs are coming, they're usually gonna lay off the departments that are costing money and not generating revenue, and they'll keep those departments that are bringing in revenue. Okay, so that's one type of center. A cost center, well, they basically just generate costs. They don't bring in revenue. What would be some examples of departments that don't bring in revenue? HR. Call center, yeah, unless it's a sales call center, but yeah, a customer service call center, generally they're there to provide service. Sometimes they can upsell you on a product, but in general, it's costs. Exactly. Then we have a profit center. Oh, accounting too, by the way. Accounting is a cost center. Profit centers really do both. They bring in revenue, and it's important that they control costs. So, so they're called profit centers. And whoever runs the profit center has profit and loss responsibility, or P&L responsibility. And a lot of times their compensation is tied to how much profit their department generates. And then an investment center would be a profit center where they can also invest the assets of the organization to help grow and expand. And in most cases, that level of authority is not granted. That's usually reserved for like executives to be able to do that. Is that the air conditioning that kicked on? Okay, first time I've heard that. So an investment center has the discretion to use some of the company's assets to invest and expand. All right, so with that in mind, we're gonna look at these, 8 companies here, or 8 examples. and see which type of center we think each one falls into. So the first one's accounting. So what did I say accounting was? Cost center, okay? Then we have a Best Buy location. That would be a profit center, that's right. Good thing they didn't use Bed Bath and Beyond, right?
Oh, you hear about the fake
Yeah. Okay, then we have the reservation department for an airline. What do you think?
Profit center?
Well, generally, they would be treated, I would say, as a revenue center. Because yes, they are gonna have some costs, but their costs are just pretty standard, you know? It would be limited to that, you know, that department's costs. Basically, you're paying for people to sit there and take calls or, you know. So that wouldn't be that important, the cost. So usually I would say this would be treated as a revenue center. And then that's the official answer. But I could see the arguments. Some companies might treat them as a profit center. Same thing with a sales department. Again, they're going to be evaluated on sales. So that would also be revenue. How about a coal store? That also would be a profit center, just like the Best Buy. Okay, how about the Hershey Company? Profit, but beyond profit, as an entire company, they could also invest their assets and expand if they want to, right? They would have that discretion. So that would actually be an investment center. That's it. Yeah. Yeah, sorry if I'm going too fast. Yeah. So G, Procter and Gamble, that is another large company that is free to invest its own assets if it wants to expand. So we can call that an investment center. The last one here, the shoe department in the coal store. What do you think the shoe department would be evaluated on? Well, but they sell the shoes, right? They're primarily going to be evaluated on how much revenue they generate. If it were a shoe repair center, then I would say profit cost. Okay. Make sense? So as an organization is figuring out who are we going to hold accountable for what, then this is the type of thing they have to look at. Okay, this one I find a little confusing. We're just going to go through it and I'll tell you what the right answers are. And I think some of these points could be argued. But as long as you know the right answers, that's all that matters, right? So this is a scenario where we have a middle school assistant principal who's just been hired, and she has all these activities she has to do. And we have to decide which of these are short-term goals, which are long-term goals, and which are both. So, you know what? Well, okay. Yeah, we'll do it one by one. So the first one says to conduct teacher walkthroughs, observations, and evaluations for teachers of grades 6 and 7. So the answer there is short-term. And I think that's because it's something she could start doing immediately. On the other hand, you could argue that that's something that she should probably keep doing, right? But if I'm remembering correctly, they're calling it a short-term goal. So let's double check and make sure. No match. 4. Short term. Okay. A, they're saying is short-term. B, assist the district's mission in seeking to educate all youth in the school district. So I would say that's something she could start doing right away. She can assist. It's kind of very vague, seeking to educate all youth in the district. But for some reason, I guess because it's such a large goal that probably you never fully accomplish, they're calling it long-term. C says train to be a building instructional leader, act as building administrator in the absence of the principal. That's what they say. I mean, we don't really know how long the training takes. I don't know. D, attend meetings with building principals and administrative team when called to do so. That's also short term. E, engage all students in a meaningful way, support teachers and staff, adhering to district, state, federal law. Okay. I think they call that both short and long term, but let's double check. So we got so far short, long, long, short, and then yeah, it's both short and long term. I'll just put B for both. Okay, then we have F, facilitate and supervise all federal and state mandated drills. So that is short. Dress professionally is short. And assist the building principal in all job duties and responsibilities is both. So we had short, long, long, short, both, short, short, both. Okay. We're done. We're done with that one. I don't know. I just don't like that one. It's just vague, right? Like, okay, how do you define goal? Well, what do you mean by that? Because is it something that has to be initially completed, or I mean, there's some of these things are never going to be completed, just ongoing. How's that a goal? I don't know. But I guess what we can learn from this is that in holding managers and departments accountable, there do have to be goals. Some of those goals will be short-term, some will be long-term, some will be both, right?
Should be like an ongoing goal.
Yeah, we could have that too, right? To maintain something, right? Could be a goal. Okay, we do have a little bit of calculating here. Do you remember ROI, return on investment? Okay. And the way we did it so far, you take your return, your profit, and divide it by how much you invested, right? That gives you your ROI. Well, in this chapter, we add one more piece of data to that. And so I'm going to go ahead. This is in the textbook, but I'm going to share this from my PowerPoint that I use in the lecture. So in fact, this one's a little better. Okay. So ROI is your return divided by your investment, right? It's going to be here. The terminology's changed a little bit. We see the word income. Income is the return, profit. And then instead of investment, they're calling it average capital assets. What they're saying there is, what is the average amount of assets that need to be dedicated to this particular initiative? In other words, how much in assets do we need to invest into this project. So it's still really the same thing. Your return and your investment. But in the middle, they stuck sales revenue. So really what's happening is ROI here is being broken down into two other metrics. So if you take your return and divide it by sales revenue, we call that sales margin. And you take that sales revenue and divide it by your investment, we call that asset turnover. Here are the formulas. So sales margin is your income or return divided by sales revenue. Asset turnover is your sales revenue divided by your average capital assets or your investment. And then if you take the result of this formula and multiply by the result of this formula, you're back to your ROI. So really what we're doing here is just taking one metric, one ratio, ROI, sticking sales revenue in there to create two other metrics. So we're kind of subdividing it, and then those two still equal ROI. All right. So if you need to, you can always refer back to the textbook and you'll find these graphics, or you can pull up the PowerPoint. Here they give some further definitions. So I said income and return are the same thing. How is that calculated? Well, income is your revenues minus expenses, which we're familiar with from the income statement, right? And I said the average capital assets are the invested assets, right? That's the investment. So how do you calculate that? Well, you can take your assets from the beginning of the year, capital assets to be more precise, plus your capital assets from the end of the year, add them together and divide by 2, and that's your average capital assets. Okay, so I know it sounds complicated, especially the way I explained it, but we're gonna use that here for these next couple exercises. So it says this company had an income, so that was their return, of 350,000. Their sales were 5.5 million. Average capital assets or their investment was 12 million. And it asks, what is the sales margin? So if we look back here, see sales margin is the income divided by the sales revenue. So we take the income, divide by the sales revenue, and we get 6.4%, right? Once we round it off, 6.4. And then exercise 6 says calculate asset turnover. Okay, so asset turnover here was sales revenue divided by the average capital assets. You have those here. So sales revenue divided by the average capital assets, we get 45.8%.
What was it divided by? 49?
Yeah. Mm-hmm. That's right. And then it says, what is the total ROI for the company? So again, we can calculate the ROI by taking the sales margin and multiplying it by the asset turnover. However, we rounded this off a little bit, so it might not be exactly right, but let's go ahead and give it a try. So it was We rounded this one off as well. So if we take 0.064 times 0.458, we get 2.9%. Now, a way we could check it is just use the usual calculation for ROI, which is return divided by investment, right? So if we take our $350,000 return, divide it by our $12 million of invested assets, we get 2.9%. So even with the rounding, still came out right. Okay. Any questions on these ratios? All right. Well, our next exercise here is on weighted average cost of capital. Anyone familiar with that concept? Did it come up before? Weighted average cost of capital? No? Okay. I think I'm thinking of financial accounting. So, does anybody have any idea what it is? Basically, the cost of capital is what it costs the company to go out and get money. So let's say the company borrows money from a bank. The cost of capital is primarily the interest rate to repay the loan. If you issue bonds, the cost of capital is primarily the interest you have to pay on those bonds. If you raise money by issuing stock, then the cost of capital is basically how much the investors are expecting your profits to grow. Doesn't mean you're actually giving them that money, but it's what the expectation is of growth for the company. And obviously, if you're raising capital through stock, that would be equity financing. The debt financing would be from loans and bonds, and equity financing would be from issuing stock. So we can see for this company, they have calculated that their cost of capital from debt is 7.5%. Their cost of capital from equity is 10.5%. What we need to do is fuse those together to get one number. But we need to weight it based on how much of their debt comes from, how much of their capital comes from debt and how much comes from equity. So that's why it's called weighted average cost of capital. So this company has $4.5 million of debt, and they've issued $5.5 million of equity. So in other words, they sold $5.5 million worth of stock. That generated some cash for the company. And then they went and they borrowed $4.5 million, either through bonds or loans. So how much capital overall does the company have? $10 million, okay. And so what percentage of that 10 million is coming from debt? So the 7.5% is the cost of acquiring capital through debt, mostly based on the interest. But what we can do, let's say we take the $4.5 million of debt, divide it by the $10 million of capital that they have overall, and we see the debt makes up 45%. And we can see the same thing here with the equity capital. If we take $5.5 million of equity divided by the $10 million of capital overall, we get 55%. So 45% of their capital came from debt, 55% came from equity. Okay, does that make sense? And together, that's 100%, right, of their capital. So now that we know that, we have the proportion that came from debt and equity, and we know the cost of capital for debt and equity, we now multiply horizontally. I'm going to take the 7.5% cost of capital for debt times 45% proportion, and I get 0.03375. That means 3.375% is the weighted average cost that's coming from debt. Now I have to do the same thing here for equity. So again, just multiplying horizontally, and I get 0.05775. So 5.775%. The weighted cost coming from equity. If we now add these two together, we have our weighted average cost of capital. .0915. So in other words, this company, if it maintains that same proportion of debt to equity, and if the cost of capital stays the same, they know that when they go out to raise more money, it's going to cost them 9.15%. Okay. And it makes sense that, you know, when you average these out based on the proportion, it's going to be somewhere in between those two numbers, which it is. Right? 9.15 would be right in there. So we have calculated our weighted average cost of capital. So we are done. Any questions on this exercise? Right. Now on to number 8. So this one's conceptual. It says, why do managers want a high return on investment? So why, you know, ROI is a really commonly used term out in the business world and the investment world. Why is it so important to have a high ROI?
Money coming in.
Okay. More, okay. It's more money coming in proportion to what was invested to get that money, right? So for example, if you invested $10 and you got back $100, you'd say that's a pretty good return on the investment. If you invested $10 and you got back $10, you would think, well, broke even, all right? Not such a great return. So why do they want a high ROI? Yes, they want generate a large income in proportion to the amount invested. So we could elaborate and say it maximizes profitability. It helps the organization be more efficient in its use of finances. I think you get the idea. So how would these managers strive to increase their ROI? How do you make your return on investment better? What's that? What was that answer?
Increase sales.
Okay.
Lower fixed costs.
Okay, exactly. So somehow generate a higher return with lower investments, right? So the more you can increase the return and or decrease what you're having to invest, the bigger your ROI is going to be. So by increasing returns and or decreasing investment. right? Since we're dividing return by investment, more returns go up and investments go down, the larger that ROI percentage will be. Okay, any questions? Well, we're just breezing through this chapter, aren't we? I have a feeling we might be done early tonight. But we do still have the problem set to get through.
The word game,
What's that?
the word game is on.
Oh, is it? Okay. I didn't know. And since we are going to be finishing early this evening, if anyone has any particular problems they want to go over from previous chapters, I'll stick around and we can go over anything you want. But anyways, let's go ahead and wrap this up. So exercise 9. Oh, here's where we get into the balanced scorecard. Okay. So I mentioned that this is used by companies that want to look beyond just their financial performance. Do you all know about the Pinto case where Ford came out with this car, the Pinto, and they were so focused on profits, there was an $11 part that they chose to leave out, $11 per vehicle. And by leaving it out, they knew that they were going to have legal costs because they knew that there would be accidents, there would be lawsuits, but they calculated how much they thought the lawsuits were going to cost. And they figured out we're going to save more money by leaving out this $11 insulation within the gas tank. And so they left it out. And it turns out that not only was that a terrible decision from an ethical perspective, because people died when the Pinto got hit from behind, it would explode.
Oh my God.
Yeah. It was also a bad business decision because their math was off and it ended up costing them way more with all the legal costs, and they had to recall all the Pintos and put those parts in. So that's what happens if you look only at the financial things, right? If you ignore other aspects of your business and only focus on the finances, you can kind of get tunnel vision. So some companies use this balanced scorecard approach, where you do look at the financial perspective. Obviously, companies have to, even nonprofits, even government agencies have to pay attention to their finances because money is not unlimited, right? You got a budget you have to stick to. But with the balanced scorecard, you also look at the internal operations of your organization to see, are our processes efficient? Are we doing things to the quality levels that we expected? So both efficiency and effectiveness. Then there's the learning and growth perspective, and this has to do with how much is our organization learning? Are we expanding into new territories? Are we developing new products? That sort of thing. And then what do our customers think? Are they coming back and buying more product from us? Are they referring us to their friends? Are they complaining about us on social media, right? So companies that use the balanced scorecard, they look at all 4 of these areas. And why this is relevant in managerial accounting is because managerial accountants would not only help prepare the financial reports, but also some of these other reports, which are non-financial. So what we're going to do here is we're going to look at these 6 examples and think which elements of the balanced scorecard do these most relate to. We've got 6 examples, but only 4 elements of the balanced scorecard. So we're going to have to use some of them more than once. Okay, of those 4, number of improved products relates to which one?
Yes.
Yeah, learning and growth. Okay. How about time from packaging to delivery or display?
Journal operation.
Yeah. He's on the roll. Okay. How about production costs?
Financial.
Financial, yeah. When you hear the word costs, that's a trigger. We're now talking about financial perspective. Okay, and number of customer suggestions.
Customer perspective.
Yes, customer. Okay. Sales mix revenues. Yep. So again, revenues are measured, in dollars, so that's financial. And number of repeat customers. Customer. All right. Okay, so we've completed the exercise set. Any questions before we move on to the problem set? You know what? Normally be break time. Let me open up the problem set. I don't think it's going to take us that long, but let me double check. Where'd it go?